The Money Show.
Personal Finance with Warren Ingram.
Thursday night, so that is Warren Ingram time here on The Money Show, director at Galileo Capital, personal financial advisor. He joins us and gives of his time so that you can better invest money and that your money will give you better returns over long periods of time. And I wonder, Warren, whether or not the term of investment diversification, this thing that has been the absolute staple of any investment idea. Diversification. Don't put all your eggs in one basket. All of the legends, all the things our mothers taught us, all of that stuff. Investment diversification, it's not working, or is it?
It certainly hasn't worked as well as it should, Bruce. This year in particular, it's actually been pretty catastrophic, especially if you were a global investor. You know, one of the things that we were taught at investment school was, you know, when stock markets get rocky, you know, that's okay if you've got some of your money invested in bonds, because those, especially, you know, the big bonds of big governments, those are fairly stable things and will give you good capital protection when times are bad. This time around, it's almost as if bonds have been performing like shares have. You know, they've actually lost huge amounts of money, and the biggest economies, so, you know, the US and Europe and the like, have actually been the biggest culprits. It's their bonds that have caused the most damage in the world. And so, no, diversification has not worked at all, in fact, this year. And for someone like me who you know, would generally advocate, you know, having at least sort of 2/3 of your investments in a share, you know, whether it's shares or a share index, and the balance in bonds or a bond index, it's been a fairly painful experience to watch, because actually, you know, it's almost as if everyone's telling me, or the markets are telling me, that actually I should be living upside down in Australia, you know, and so that it is painful, but I'm not sure that it's the end of asset class diversification, and I'm not sure we should all move to Australia and be the right way up again.
No, but it's interesting because you know, balanced portfolios are the ideal way to go. There's an element in bonds, there's an element of cash, there's an element of shares, and you spread it all around, and you get different geographies and different sectors, and you create a bit of a balance, as it's called. This is supposedly the worst year for balanced portfolios in nearly 90 years, maybe more than 90 years, since the Great Depression.
Absolutely. You know, you know, one of the people I love to follow that gives great information on the US markets is Charlie Bellio. And you know, Charlie tells us that this is the worst year for a balanced portfolio since 1931. And for the slightly older people on this show, like you, Bruce, I mean, you'll remember 1931 wasn't a good year. It wasn't a good time to be in the economy, and certainly not good time for the investment markets, and certainly way worse, you know, economically than the conditions we find ourselves in now. So for this to be the next worst time since then is really you know, a major change. But I think to stay on the point. Is diversification as a principle wrong? No, I don't think so. You know, one of the things that we would talk about a lot as well is, you know, you need to buy assets that are offering good value, and that's been the problem with bonds. Is it's not so much that the stock markets were the main culprit here. What was really a huge problem was government bonds. In especially the US and Europe and the UK, because they had basically been propped up by UK governments international governments and international reserve banks, you know, feeding a bond frenzy by keeping interest rates extremely low. And any time that the price of bonds were moving in directions that those governments or reserve banks didn't like, they would simply, you know, buy those bonds out. They would actually manipulate the market themselves, and I mean, they didn't call it that, you know, but that's what they were doing. And so what happens is you know, very basically, and obviously it's very summarized, but they create a condition where if you've been buying bonds up until, let's say, January last year, you were almost guaranteeing yourself return-free risk. You weren't going to get any interest on the bonds that you owned, and they posed massive capital risk. And unfortunately, that story has now exploded. In fact, a collapse in the bond markets where you're seeing 20-25% losses on the capital that you put into bonds. That is a crash.
It's a proper crash, and all asset classes have crashed. We've seen very sharp negative impact on all segments of markets. But then there is one of the most overused terms in markets. Oh, it's always darkest before the dawn. I wonder if that's true now, because you can bet your bottom dollar that the moment we sell out of everything, the moment we opt out of investments, there's going to be a turnaround, because at some point we get to a place of capitulation and a point of collapse where people just can't cope anymore with the uncertainty, and they sell and rather cash in. It's a normal cycle of things. And I wonder how close we are to that point and a possible turnaround in sentiment, not only here, but worldwide.
Well, I think you're right. Capitulation is the end of the worst, and the wonderful thing about capitulation is it's really obvious to see once it's happened, once it's over, and things are getting better again. Unfortunately, very hard to see while you're in it. So I think it's for me, anecdotally, one of the best measures is reading the headlines of the international publications, especially the Americans, and looking at especially things like Bloomberg Business Week. It's my absolute favorite, because they are a fantastic indicator of what you'd call a contraindicator. So if they say, the markets are going to shoot up now, then that's probably not a good time to be jumping into markets. And if they say, there's still a lot more bad news to come, it's probably a good time to know that the capitulation has happened and it's time to start investing. So I think the point about investing in shares or maybe now government bonds around the world is you don't need to time this perfectly. You don't need to be making a massive prediction that we need to wait for the absolute worst of the worst and in markets and then start buying. I think you can rely on the second kind of core principle, which is valuations. And when you're able to lock in between 4% and 7% interest rates on very big government bonds around the world, then it doesn't matter if they're going to lose a little bit more value. What you now know is that they're offering you good value now and will be good value and will deliver a decent return for you over the next 5, 10, and 15 years. And I think we could argue very much the same for global shares as well. And actually, certainly South African shares would fall into that as well. So don't, the message here can't be that you sit and wait for capitulation, wait for everything to get better, and then start, investing your money. And certainly don't pull out now if you feel that sort of temptation to just throw in the towel to say nothing's ever going to get better. The world's just getting worse and worse and worse. What you should be saying to yourself is, if I'm feeling that, then many other people have probably made that call already, and maybe they are capitulating, and maybe this is the time to find a bit of extra cash to be an investor. So I think, Bruce, I hope I never give you the capitulation prediction to say this is it, because if I do, it probably means I've been drinking before the show. But
you're too late, frankly. I mean, once you make the capitulation prediction, it's often too late, and that's the thing with most of these sorts of predictions. I mean, we're going to summarize this part of this conversation. Asset class diversification remains a strong strategy. You do need to have a mix of assets. You can't now be sitting after the year that we've had so far and going, okay, next year bonds are going to recover, so I'm putting everything into bonds. Or next year property is going to be great. Or next year shares are going to be great. Industrial shares or manufacturing shares or banks are going to be great. Or resources are going to be great, particularly platinum group metals. We have no idea what's going to be great next year. Not a clue. No idea.
You're right. I think I think at the moment you're humble enough to realize that, and then understanding that the best thing to do thereafter, once you've come to the stunning realization that you can't predict and you don't know, then do what the fund managers haven't realized, because they all believe they can predict. And so walk away from that and say, okay, I stick to a good diversification strategy. I do go overweight in shares, but if you haven't had global bonds in your portfolio, it's time to start buying and not, as you say, don't go overweight and suddenly make that 90% of your portfolio because you believe 90% in bonds and 10% in shares is diversification. That's not good either. I still think the 2/3, 1/3, 2/3 share, 1/3 bonds is not a bad idea. But just understand it's still going to be volatile, it's still going to be rocky, it's still going to be messy, but going to be financially very rewarding if you're patient and stay within your disciplines.
Okay, good. Thank you, Warren. In a moment, more with Warren Ingram. Zane is calling. This is quite an interesting one because I'd never thought about this as an investment. I saw it as life support. But Zane's question: load shedding's become a real thorn in my side. I'm seriously considering solar as a solution. But as you know, it's not cheap. Would you see this as a form of investment? Would the value added to my home and the monthly savings on electricity justify it? Good question, Zane. Is load shedding protection an investment? I have a thought. I'm sure Warren has more than one thought. In a moment.
The Money Show. Personal Finance with Warren Ingram.
So is protecting yourself against load shedding an investment? Does it add value to your property? Is that the way you should be looking at it, Warren?
I think it's the answer. Maybe 2 years ago was no. I think it was, as you said, it was probably more about life support and the like. But I think now it is becoming more and more of a factor for potential home buyers and certainly home renters. If more and more people are working from home, whether it's 1 or 3 or 5 days a week. And so for them, and whether they own their home or they're looking to rent a home, having load shedding protection becomes increasingly important. And so I think I'm going to change my tune. If someone had asked me 2 years ago, I would have said, no, it's just a very good idea. But now I think it does become more and more financially rewarding. Simply because you probably won't lose too much on the capital that you put into that when you sell the house. And if anything, I do think it will give your house extra value. And the one caveat though is understand that you need to do this really selectively. Don't go over the top. So when you do the research, what you'll find is to take yourself completely off the grid, to be completely self-sufficient from batteries and solar and the like is enormously expensive. But to get to the point where you can provide, let's say, 80 to 90% of your house's power requirements in load shedding is way cheaper. And so that would be the one thing I would start out with. And then secondly, if you're Zane in looking to make this a financial decision, you need to understand that your best financial decision is actually to put solar geysers on first before you do anything else, because actually that's where you cut your electricity costs by about half, if my numbers are correct. And then, your power requirements for your house are certainly a lot less if water is taken care of by the sun. So I think it is an important financial calculation. The hugely frustrating thing is that the municipalities are incredibly backward. I think the first one to actually start offering some kind of payback to people who want to put power back into the grid from their houses is Cape Town. If you look at the tariffs that they're offering you, they're absolutely pathetic. There is no other way to describe it as far as I'm concerned. So the reason is the municipalities will make more money by selling electricity to you. That's how they make a lot of money for themselves. So they're not going to make it lucrative for home buyers to put electricity back to the grid at a fair price. So it's never going to be rewarding from that point of view. It'll just be slightly helpful. But last point on that will be, certainly electricity prices are not going down anytime soon, whether you buy them from Eskom Direct or municipalities. So to protect yourself from future inflation on electricity costs as well, when you actually are getting it from the grid, solar does become more and more viable. But I think don't be driven by ego and take your house off the grid and expect that to be financially rewarding. I think that's going to be hugely expensive.
I would look at it slightly differently, and I take your economic arguments very, absolutely. But there's another very, very important factor here, and that is peace of mind. And how much of your day is dominated by being really miserable and losing focus and losing energy and losing the will to actually carry on by the fact that you've got 2 bouts of 4 hours of load shedding or 2 hours of load shedding a day, generally at the times where you're trying to put your kids to bed or cook a meal for kids or get them up, especially on cold, dark winter's mornings. It's that sort of destructive psychological impact of a loss of electricity that is, to my mind, worth spending the money to protect yourself from. Because then if you've got a stable electricity supply and you can ride the load shedding, it's almost if it doesn't exist in your little bubble. And you're able then to focus on what really matters. I would say that's worth its weight in gold, Warren.
Yeah, I mean, that's return on life, and it's a brilliant, brilliant summary, and especially for people, parents with kids. I mean, there's no chance if kids need to be doing homework and the like, that you're telling them to go and play outside in summer and hide under the duvet in winter. You need to make a plan, and I think we just need to be realistic. The problem, the Eskom problem. I mean, there is no one that's sort of reasonable in this whole thing that says that the problem goes away in anything shorter than 18 months, and probably 24 months is more realistic. And we know prices will go up at least once or twice in that time. And so to solve the problem yourself, we pay for private security. Most people, that if they can afford it, they pay for private education. This is one of those things where if you've got the financial means, insulate yourself from municipal and government incompetence and take the frustration levels way down. It is a huge return on life.
Worth its weight in gold, that is. Thank you, Warren Ingram at Galileo Capital, wrapping up this evening's edition here of The Money Show on a Thursday evening.